Good evening. Hi there. Shervin Joseph with FitzGerald Financial TowneBank, a division of TowneBank, along with Sean Higgins, Senior VP with United One Resources. And this is our fourth installment of a four-part series on credit and everything you need to know about FICO score and mortgage one, mortgage products, mortgage grant programs. Right, recap last 3 weeks, the last three shows that we've done to discuss and hopefully answer every question that's out there. And we had some great questions last week with regards to credit, with regards to FHA, with regards to VA, and with regards to USDA type loans. So tonight we're going to do the credit piece again, and we're going to do the Mortgage 101, kind of recapping what we've done. But anytime you have a question, any question at all, we will interrupt. Feel free. It's not an interruption, but we'll stop, answer the question, and then proceed. So, look, I've just to give you some background. Sean has been in the business about 30 plus years. In the event that this is your first time attending, I've been in the business about 36 years. We've been doing these events for a little over 15 years. We trust each other immensely. That's why we're doing it together. And our trust and our respect is for the audience to ensure that we do something about literacy with regards to home buying and building wealth and closing that home ownership gap for people of color who, according to the U.S. Census Bureau, is at about 44% for Black Americans. And for white Americans, according to the U.S. Census Bureau, it's at 75%. So if we could assist folks in understanding the process of how to purchase a home, we would have accomplished, even if it's one person. But the wave of folks that we've seen ask these great questions, we're just a little bit taken back in a positive way that we've had, and we hopefully have had an impact. So without further ado, Sean Higgins will start us off with everything you need to know about your credit score.
Thanks, Shervin. I have a presentation I put up on the screen now, and we'll talk a little bit about credit scoring. Very timely. There's some big changes announced in the credit scoring world just yesterday. And we're going to see a lot of things change over the course of the next couple of years. But for right now, the information that we're going to show on the screen is going to be very, very much in line with what's actually happening in the industry now. As Shervin said, we really enjoy working together and making these presentations. I'm glad to have a small part in the whole process. My goal is to hopefully reach a couple of people throughout this and let them know about the myths and the truths of the credit scoring part of the whole mortgage process. So I'm going to put my presentation up on the screen. There's my contact information. If anybody ever has any questions or anything they'd like to ask offline, myself or Shervin are both great to speak to. One thing that I want to let everybody know right up front is I'm not a credit repair clinic. I'm a credit reporting agency by definition, and we work with lenders. So my company and my team gets involved in the process with lenders like Shervin, and our goal is to seek out score improvement. We'll talk a little bit about score improvement, but we also provide a foundation of good information on how the credit scores will work. So as I said, there's my contact information. Anybody has any questions offline or anything like that, feel free to reach out to me. So credit scoring, as Shervin will say when he gets involved in his conversation, it's one of the most significant factors in getting a mortgage. A credit score really is I'd like to use the term, it's a snapshot. Everyone has 3 credit files with the 3 national reporting agencies, Experian, Equifax, and TransUnion. And the credit score, upon the request of a credit report, is appended to the credit report. The mortgage lending presently uses FICO score version 8, okay? At that point in time, The credit reports are analyzed by Fair Isaac Company. That's what the acronym FICO stands for. And they append the credit score. It's really, really good for consumers to have a good idea of what's in their credit report, because believe it or not, sometimes there's erroneous information in there. You'll hear me use a term tonight called credit fitness. And credit fitness is something that I think everybody should try to get involved in. That's where you have a good awareness of what's going on with your credit file and the things that are on there and how they impact you. There's enough free information out there that people really shouldn't be surprised in what's in their credit report. One thing that you'll hear me say consistently throughout the process is you should always start with the mortgage lender. They have access to your credit report upon your approval, and they'll work with companies like myself to simulate score improvement and help you get through it. So the score ranges. Right now, the score ranges, they're not going to change. They're 300 to 850, okay? We generally get involved with our lender clients of when the scores are in the fives, upper fives, and try to move them into the sixes and the sevens, depending on the loan program. Shervin will spend some time talking about the credit scores that are needed for the different loan programs out there. On the high side, an 850 is about as high as you can get. And in my 30 years of doing this, I've seen about 2 of them like that. So they're really, really what they would call a statistical anomaly. Most people fall in the 670 to 730 score ranges. So there's a good idea of what the band is for credit scores. So we get asked a lot, what actually impacts a credit score? So FICO, which is, once again, Fair Isaac Company, has done a nice job putting together some information that's available. So you'll see that there's a couple different factors that have an impact on your credit score. And the biggest one, obviously, is your payment history. So if you're paying your bills on time, that's going to lead towards a very strong credit score. Your amounts owed, or you'll hear me use a term as we get further into this, utilization, that's the second biggest factor. And really, utilization has the biggest impact on revolving debts. Revolving debts are also known as consumer credit cards. Probably a credit card is the best way to describe it, but it's in the industry, it's called revolving debt. And the reason it's revolving is because it changes all the time, depending on how much your balance is and what your utilization is, which is going to be a calculation of your balance versus your available credit. The rest of the factors that are listed, your length of credit history, any new credit, or your credit mix, they have a lesser impact on your score. So really, the 2 things that are the biggest impact in your credit score are going to be your payment history and your utilization, or your amounts owned. Okay. Next slide. So let's start with the basics. So an inquiry is an important word in the credit report process. An inquiry is when you, as a consumer, allow a lender to make an inquiry into your credit files. There's 2 types of inquiries out there. There's a hard inquiry, which is used in connection with an application for credit. A credit report is accessed with the consumer's approval. There's also a soft inquiry. A soft inquiry is if you have an existing relationship with a creditor, they may want to review your credit report. There's also soft inquiries that are used for pre-approved offers of credit. But most of the time, when you look at your credit report, you'll see the hard inquiries listed, and they should be in alignment with your expectation as far as who's actually pulled your credit report. Another question we get as far as credit inquiries is, do they have an impact on my credit score? The general rule is if you make a mortgage application, you can expect your credit score to go down by about 5 points 30 days after. Okay, it's not a big deal. Sometimes people are sensitive to that when they're making an application, but a strong, well-seasoned loan officer will tell you that it's a very important part of the process, and it's going to be a small impact to the credit score. Inquiries can have a greater impact if you don't have a lot of credit accounts established. And really, where people can get in trouble with inquiries is if they're out shopping for different things. For instance, if you're shopping for a car, they may shop your loan application to as many different lenders as they have access to, or the different manufacturers that they have. If that type of stuff happens within 30 days or even a less period of time, it's not going to have a big impact on your credit score. FICO does tell us, though, that if there's a large amount of inquiries on your credit report, throughout an extended period of time, they tell us that statistically, people with 6 or more inquiries on their credit report can be 8 times more likely to declare bankruptcy than people with no inquiries. And the reason they say that is if someone's constantly shopping for credit, it's a good indication that they're maybe trying to get out of debt or move debt around. And it's a little bit of an indication that there may be some problems with that person's payment history. And they've been able to tie it to more likelihood of declaring bankruptcy. So how do you improve your credit score? Well, everybody has a base credit score that they start out with. It's not forever, okay? You can improve your credit score by paying your bills on time, keeping the balances low on your credit cards and any other revolving credit products that you may have. You should probably only apply for credit accounts when you need them. Good credit management practices will help raise your score over time. So if you do have some issues with your credit score, you can go ahead and you could reestablish your credit history. Opening new accounts responsibly and paying them on time will improve your score. As I talked about credit fitness a little bit in the very beginning, there is a free service that's available for consumers. You can access your credit report through annualcreditreport.com. You can access your credit report every week through 2023. And the reason that is because of the COVID period that really brought that about, and they decided to keep moving it forward. Annualcreditreport.com. It's a free service. There will be some challenge questions where people should know what streets they lived on and what institutions they may have had loans with, et cetera, et cetera, et cetera. And those are really put in place to prevent anyone from having access to your credit report that shouldn't. So what really drives down your credit score? Anything that's currently late, that's going to have a negative impact, probably greater than 100 points, okay? Recent lates on accounts, high balances on unsecured credit cards. So the rule that we like to use is 20 to 30% utilization will have the greatest impact on your credit score. That's really ideal. If you're up around 100%, where we've seen credit reports with consumers with in excess of 100% on their credit cards, that's having a significant negative impact on your score. And with our simulator tool that I referred to earlier, we could simulate how much of a pay down will actually have a positive impact on that credit score. If you have any unpaid recent public record information, that's going to have a negative impact on your score. And also the lack of any open active trade. We saw a consumer recently, we were looking at a report with a lender trying to help them improve the score. Everything was paid. Everything had been paid for 5+ years. There was no active credit. And it was the credit score was being impacted. We were able to get around that by having the consumer open up a new line of credit. A new revolving account, and it worked pretty well. So it doesn't make sense to close down accounts after they're paid. It always makes sense to keep them open. That's a question I get a lot as well. So how are you going to improve your score? As I said earlier, a recent late is going to be a big impact on your credit score. As I said, probably close to 100 points. If you have a situation where you only have one-time occurrence of something like that, there's a good chance that your credit grantor is going to go ahead and waive that if you ask. You have to be in good graces, meaning that it could have been a one-time occurrence. It's not really a true indicator of who you are. And if you have a conversation with that credit grantor and explain that, this is really hurting my credit report, it's a one-time thing, can you actually remove it? And they will. If you have a collection account on your credit report, that's something else that'll have a pretty significant impact on your score as well. We've found that collection agencies are really salespeople as well. And they are willing to work with you to get the payment from you that they've been hired to do. You got to remember that trade line does not belong on your credit report. It's there as a tool to get you to pay a bill. We always advise consumers when you go to pay off a collection account with a goal of improving a credit score, you should make sure that they're willing to remove that from your credit report. Getting those revolving debt balances below 20%, as I said, that's a big, big positive impact on your credit score. Student loans, a lot of student loans out there are being improperly reported. Student loan debt sometimes can be put into deferment, and there's sometimes issues with the servicer, say a Sallie Mae, say a Navient, those types of companies. They may not have all the paperwork up to date as they're reporting your student loan to the credit reporting agencies. So if that is in fact the case, we can help you get that removed, that late removed, and get that all straightened out on your credit report. But the key is, in order to work with us, you have to work with the lender. Installment loans do not have a big impact on a credit score. So if you want to pay off an installment loan soon, it may help you get out of debt faster. However, it has little impact on the credit score. And Shervin will talk about this a little bit more. It may make sense to actually take those funds and use them on more pressing items, which will impact your credit score in a positive way. Credit Karma. 100 million users of Credit Karma in the United States. 1 out of almost every 4 people, between 3 and 4 people, have a Credit Karma account. It's very interesting. It's a very great tool. As I said before, credit fitness. It's probably one of the best tools there are for credit fitness. Credit Karma is free. You could check it every day. You can check it 10 times a day if you want. You won't have a problem. There's differences between that and the score that we presently use in mortgage, which is FICO score version 8. Credit Karma score is not used. Score ranges are the same, 300 to 850. When Credit Karma is providing you with that free service, they're excluding Experian. Experian just does not participate with Credit Karma. Whereas with FICO 8, we look at all 3 bureaus. Payment history, credit utilization, so on, just as I said in the prior slide, are the score factors. However, Credit Karma is a little bit less, a little bit less specific in how they actually calculate the score. They do not show a lot of the things. The Credit Karma score is called the Vantage score, VANTAGE. It's the word advantage without the AD in front of it. That's the difference in the scores. FICO score does not consider rent utility bills, whereas the Credit Karma score does. The most important thing to remember when you're dealing with the differences in the 2 scores is the Credit Karma score is probably going to present about 30 points higher. So when you go to make mortgage application and you are someone that is a Credit Karma user, you're going to have to take that into consideration when you're sitting with your mortgage professional. The scores are different. The reasons are different that they use. It's a different calculation, and it's going to be about a 30-point difference. A lot of consumers have Experian Boost. Experian Boost is great when you're trying to build credit. It's for people with thin credit files. So say you want to get a landlord to approve you or something along those lines. It's a great product. However, it's not going to be considered in the FICO score that we use for mortgage, which is FICO score 8. It sometimes can become an issue when you're in the mortgage application process. And if it does become one for you, your mortgage professional will advise you to just log on to your Experian Boost account and opt out. The trade lines will fall off immediately. Rental information. A little bit over a year ago, Fannie Mae decided that they're going to include rental information in the mortgage decisioning process. There are documentation requirements for rentals, verification of rents in the mortgage process, but it's has been more in tune with Fannie Mae's what we call their decision matrix. The rental payments are not going to be part of the credit score. That's the one thing that was out there in the very beginning, but it's not. It does not impact the credit score. It is, however, very, very important part of the process. Last 2 slides, medical collections. This is a big deal as far as I'm concerned. So starting this past July, a paid medical collection debt will no longer be included on a consumer's credit report. This was really, really a bad thing with the consumer's credit score. A consumer would end up in medical collections, pay it, and the collection agency would not remove it. The credit bureaus, Experian, Equifax, and TransUnion, got a lot of complaints on that. And they took a great step forward, and they said when they're paid off, they're off the credit reports. That's somewhere between 30 and 100 points that a consumer can pick up. Also, this past July, the time period for a medical collection to be reported on a consumer's credit report extended from 6 months to 1 year. Even bigger, starting in 2023, a medical collection debt, and this is an unpaid medical collection debt, has to be at least $500 for it to make it onto a credit report. There were a lot of small balance nuisance medical collection debts that were on the consumer report that were causing all kinds of problems. So they have to be at least 500. And in order to get the best possible score, they need to be paid. Last, there's the contact information for the credit bureaus. There's the contact information to get your credit report from annualcreditreport.com. And then if you think back to what I said earlier on, as far as having pre-approved offers of credit, there's the way to remove them. That's a big way to get rid of identity theft in your life. Optoutprescreen.com. It'll stop the approvals from coming in and maybe ending up in your mailbox and maybe even ending up into the hands of the bad guys. That's really what I have. I hope we were able to clear up some of the misconceptions or concerns about credit scoring. It all starts with the mortgage professional like Shervin Joseph to get you on the right path with these things and to get access to the things that we discussed as far as the simulator and getting you into the best possible way. That's all I have for today, Shervin.
All right. Thank you, Sean. As usual, just awesome. Absolutely outstanding. A couple questions. With regards to getting, resolving some of this collection debt or past collections or even charge-offs, how difficult is it to go through that process?
Not difficult at all. I know it all comes down to documentation. As far as the medical collections, if they're paid, we like to look for some type of a letter from the collection agency or a balance that shows that the debt has been paid. And we could take that to the credit bureaus and have that removed from the credit report within 2 to 3 business days. Charge-offs, we generally advise people to pay them. A paid charge-off, although it will not be removed from a credit report, if it wasn't a medical collection or a collection, a paid charge-off is going to have a very positive impact on the credit score. And they're very easy as well. I know in our practice, Shervin, with your company and the others that we work with, we can sometimes assist the consumer in making those calls to whomever we need to assist them in getting this resolved. But by and large, if there's not a payment, it's not going to work, but we can assist in helping them get what they need.
Got it. Thank you. Thank you. Oh, and lastly, Credit Karma. Isn't that, I know it's a great tool, but isn't their score inflated by a certain amount over what we use?
You're going to see a 30-point difference all the time. And I know we talk to the loan officers quite a bit about that when a consumer comes in and they have an expectation of a certain score.
Exactly.
The clients that we work with are very well educated in the process.
Yep. Very true. Well done. Thank you so much. Thank you. All right. So at this point, I am going to share my screen. And just to give you a quick background, I've been in the business about 36 years, former Marine. So I know quite a bit about VA loans, government loans, regular conventional loans. You know, I've held just about all the positions in this business when it comes to originating and so forth. So we're giving you accurate information. Sometimes that's lacking in the industry, that folks are not getting accurate information so they understand how the process works. What I'm going to do is I'm going to start going through the slides. However, some I'll accelerate because, again, this is a recap. So if you have questions, please feel free to ask your questions. So you want to, why choose us? Well, TowneBank Mortgage, which is our parent, is a bank that Forbes magazine back in January, February named number 9 out of about 5,000 banks in this country, performing banks. So that gives you the you have some perspective of where we're coming from and the quality of an organization that we are. I like to think we're the leader in diversity. Well, I also like to think that we are going to go above and beyond to make sure folks get into these homes and they get approved for the mortgages. However, it starts with being pre-qualified. It starts with setting yourself up to be approved. So you have to understand the process. No one's just walk in and say, hey, forget your credit score. Don't worry about it. You just heard about 15, 20 minutes of great advice on credit score and why it's so important. So it's vital that you take action with regards to your credit. So what we do is we tailor make loans for you, for your situation. But like any other entity, we have our guidelines that we have to follow. and we follow Fannie Mae, Freddie Mac, FHA, and VA guidelines. We give you personalized service. Someone like myself is ready to assist you through the process and guide you through to ensure that you have a seamless process. We're very aggressive as far as competitive pricing. We are known for our closing on time. And in most cases, I know my team, we try to close everything in 3 weeks. And a lot of that is predicated on the customer being prepared. So again, you have to get into what makes you prepared, what makes you ready to be approved, and all of it starts with a pre-approval. So if you're thinking of buying a home and you have the option of renting to own, to me, it's a no-brainer, but I'm in the industry, so it's easy for me to say that. But think about it. With rent, you have no control over your rental increase. Every year it's going up, and now rent is as high as it's ever been in this country, particularly since post-COVID. There's no tax deductions for renting. You have no privacy for the most part, and you're limited in your ability to personalize your space, your home. You can't really do what you want because you have certain guidelines that the landlord wants you to follow, or the apartment complex. So you really don't have the true home feel. And if you own, you're building equity. And that's the beginning of wealth. When you start building your equity and accruing wealth, that's where it starts. You could claim a tax deduction. There's 0 down payment options, which I'll get into as we move along. You could customize your home to the way you want it. It's your home. And there's fixed payment options. So your payment, it's not going up on an annual basis. So you have to ask yourself, are you ready to buy? Do you have a steady income? Do you pay your bills, including your rent, on time? Do you have low to medium debt? Do you have any money in savings? Do you have the ability to make the mortgage payments? Do you have okay to good credit? Well, you just had 20 minutes on what it takes to have excellent credit. And it's not just excellent, it's okay to good credit. Don't think you have to have a 780 or 800 score to qualify. A minimum of 620, and we could start talking about how we could get you in there. And even if you have a little lower, we'll give you a blueprint and tell you what you need to do to get to that point. We have a simulator along with Sean's credit agency that we know exactly what the Bureau is expecting, and we can pass that on to you so you know exactly what you have to do to get your score to a certain point. The importance of getting pre-qualified. The realistic pursuit of properties. Okay, you can't purchase a property unless you're truly qualified, pre-qualified. Most realtors are not going to speak to you until you've spoken to a lender, until you have that pre-qualified qualification letter or pre-approval letter. That says that you're ready to purchase this house in this price range, not just flying by the seat of our pants, hoping that we could purchase a home. You have to understand the differences between what you qualify for and what you really can afford. Understand the loan programs and how to use them to leverage your purchase. And we discussed loan programs last week, as we'll do a snapshot of it tonight. Review your credit for accuracy beforehand. Sean gave you ways that you could check your credit. Annual credit report is a free credit report that you could get all the time. You know, you have options. Obtain a yes or when answer to your application rather than a no. That is critical when you're going for a pre-approval. So understanding the differences is absolutely vital. Qualifying factors, the 4 C's: capacity, credit, capital, collateral. Your income, capacity to repay the debt based on your earnings and employment history, expenses, and number of dependents and other obligations you have. Credit, history of how much you owe, how often you borrow, and if you pay your bills on time and if you're living within your means. Assets, capital, or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair or replacement expenses that may arise after you're in your home. Property, collateral to protect the lender's investment if you can't repay your loan. The home you buy must be worth enough to back up your loan. That is absolutely critical. That's where the property and the appraisal come into play. It's vital that you get the appraisal so we know exactly where you're going. Rates, I'm going to just pass through that a little. Interest rates, just to the elephant in the room, rates are a little high right now. And I don't say it's out of control, it's high. But if you know anything about mortgage interest rates, pre-COVID, just maybe a year or two before COVID, we were in the 5% trending on a 6% range. So then right before COVID, we went into a nice lull, and it's been great and the 2 years of COVID where the rates kind of stayed, pretty palatable. Everybody got a little complacent. And then, of course, inflation set in and the Fed decided to do something about it. And so rates started going up. So you have to be prepared for it. But the one thing that you have to know that there are lenders that are going to push the envelope with the rates to make sure that you have a rate that's palatable for you, even in this market. Some lenders require that you put down 20% of the purchase price. And I hear that all the time from borrowers that call me or come in for an application and said, we don't have 20% down. You don't need 20% down. 20% is if you're doing a conventional loan and you're trying to avoid mortgage insurance. So unless you put down 20% on a conventional loan, you could put 3%, you could put 5%, 10%, 15%. That is up to you. But to eliminate mortgage insurance that protects the lender against anything happening to the property, you have to put down 20%. Government loans such as FHA and rural development, which is USDA, will have mortgage insurance no matter the down payment. But with FHA, their mortgage insurance is set for life, and USDA is so minuscule that you really don't feel it, and it's amortized over 30 years. So which mortgage is right for you? So last week we covered the FHA, USDA, VA. Conventional is pretty vanilla with regards to you can buy it with as little as 3% down. Great for buyers with good credit. But again, if you have 640 and above, you're pretty well in good shape. 620 and above is more of an FHA. FHA, as you can see, 3.5% down. Great option for first-time home buyers who just need a little bit more flexibility on credit. The requirements give you a little bit more latitude with regards to FHA. There is an FHA product that's a renovation program. My suggestion is you leave that for folks that have experience and they've had a mortgage before, so they understand how the mortgage works, than to get a rehab mortgage and to get the funds into the mortgage and get drawers to fix it up and all that good stuff. It's a little tedious and it requires a lot of attention to detail. So it's not a turnkey with regards to getting your keys right at closing and moving in. USDA is perfect for rural buyers, but it's also perfect for folks that are just on the outlying areas of the suburbs. It's 100%. There's 200% programs, loan options, period. Anybody telling you any different, they're going to add some kind of grant program to make you think it's 100%. Two true 100% programs. USDA is one, and you have to have decent credit, FICO scores usually around 640 to 660 range and above. And that's a great instrument to purchase a home. No money down. And let's say the seller's paying closing costs, so you get a grant program to pay your closing costs. You could walk in with no money out of pocket. And then there's the VA loan. If you served your country and you know that you have VA eligibility, there's absolutely no reason that you should not either have used it or inquire into how do I see if I qualify for a mortgage, what do I qualify for, and so forth. It's 100% financing is available. It's the one loan. Seller could pay all your closing. Again, you don't need a grant program to walk in with no money down. But let's say the seller isn't paying any of your closing, you could get a grant pay program and you could walk in with no money down. There's no monthly insurance. There's a VA funding fee that's attached to it, and that helps finance, guarantees the loan. So again, one of the best products available. We just discussed the conventional, the FHA, and the VA, and the USDA. 2 weeks ago, we discussed grant funds. The mortgage, Maryland mortgage program has 3%, 4%, 5% grant assistance. Again, you need to call me with regards to the particulars on those grant programs. They have a dead stop on your debt to income ratio where we could push the envelope when we're lending, if it's just a regular loan without a grant program, higher than 45. The Maryland mortgage program is a dead stop at a 45 ratio, regardless of if you're at 45.1, 0.2, 0.3, it has to be 45.0, period. But it's a great grant program. Again, 3, 4, 5%, and they're different options. The MMP First Advantage 6,000 also has towards down payment and closing assistance. Home Start down payment assistance program as well. So there's different types where you could get down payment assistance programs to help with your past student loans and so forth. The DC Open Doors, as you can see, 0 down payment up to 100% financing, no first-time home buyer requirement. Maximum DTI is 50 in their case, but that's DC. And you see FHA loan is a 45% DTI unless credit score exceeds 680. So you have to read all the fine print so you understand what is available. Maximum loan amount is $647,200 in the district. Maximum borrow income limit is $154,800. And that's for conventional and FHA programs. There's the FHLB programs up to $7,500 for assistance for closing costs or down payment assistance with a minimum contribution of $1,000 from the borrower. And then there's the VHDA programs as well for Virginia that has different programs. The student loan situation. And we've come a long way with student loans. In the last 2 to 3 years, we've gone from just using the balance, whatever the balance of your student loan is, we used to have to put 1% of the balance as your monthly payment when we qualified you, regardless of if it showed deferred on your credit report. And that is critical. You have to understand there's a lot of people that were not qualifying. Then we went to the 0.5%, which that's where we are now. However, I just want to read a couple of these for you. For student loans that have a payment reported on the credit report that is greater than 0, you may use that payment in qualifying. Okay, that's greater than 0. So let's say you have $25 payment as an example on your credit report. you could use that. For student loans that have a payment reporting on the credit report of 0, you may use a payment equal to 0.50 of the loan balance. Far cry from using 1%. And particularly if you have student loans up to $200,000, or you take $2,000, and don't count the rest of the car payment, credit cards, and so forth, you could be in trouble for qualifying. If a payment amount used to qualify is less than the monthly payment reported on the credit report, the lender must obtain written documentation of the actual monthly payment status, and evidence of the outstanding balance in terms from the student loan creditor or servicer. Income-based repayment plans are acceptable with documentation from the student loan entity. We used to not be able to use income-based repayment programs unless it was fully amortized and so forth. Now, income-based repayment plans are acceptable as long as you have your documentation from the student loan entity. So if you're paying $10 a month based on your income and so forth, that might be a win for you when you go to apply for a mortgage. VA loans, amount listed on the credit report is acceptable. Balance divided by amortization period, though. For example, $45,000 amortized over 240 months equals $189. So it goes on and on what you could do with student loans, and we welcome calls once we pull your credit report to see exactly the way it's structured. Now, we just discussed credit, so I'm not going to do anything with scores because, as I always say, you have the best in the business that just did a presentation that can't be topped. I'm not going to try to do that because that's why he's here, because he's going to give you accurate information right from the right from the credit bureau. So here you have the home buying don'ts, and I'm very, very big on this, and it's highly critical of our experiences as loan officers, loan processing, and compliance folks, that we see errors being made by customers all the time, and it's all self-inflicted and can be prevented. So we go out of our way to give you this information beforehand to ensure that you understand in the process the don'ts while you're going through the mortgage process. Number one, do not change jobs, become self-employed, or quit your job. Folks, I've been working with some folks, a couple, and while he could afford the price tag, which is a very big price tag, he said, yeah, if we go up, if we increase the loan amount, my wife could go on the loan. So, all right, no problem. But I've been working with them, and we've had this discussion. He's looking for a very high price tag, and with his wife, he'll be fine. She's a doctor. However, 2 months ago, she went self-employed. She can't go on. You have to have 2 years tax returns to have the payment, the income history that is required. You can't have just 2 months self-employed. So it's critical that you understand becoming self-employed puts you in a whole different situation than a W-2 person. Self-employed borrowers require 2 years tax returns. That's a dead stop. There's no going around that. Number two, do not buy a car, truck, or van. We know car, truck, or van, and it's not the old days of a $200 payment. $500, $600, $700, $800 payment, depending on your income, could throw you for a loop in trying to qualify. So don't do it until after you have purchased your home. Number three, do not use credit cards excessively or let your accounts fall behind. Just because you've gone through loan application doesn't mean that right before you close that the lender won't pull a soft credit just to make sure that there are no additional debts from the loan application till the date of closing. Keep that in mind. Number 4, do not spend money you have set aside for closing. Leave the 4-day weekends in Cabo alone until after you get your house keys. It's critical that you don't do anything foolish. And we've seen people do that. Oh, I just went away, but I didn't know I was going to spend that kind of money. And, there it goes, up in smoke. Number 5, do not omit debts, liabilities from your application. Again, a soft pull, and there's so many software programs that are run, you don't know what's going to come up on any of those programs that will identify a debt that wasn't disclosed. And then you're going to have to explain it and why wasn't it disclosed initially. Number 6, do not buy furniture. Wait till you have your keys to the house. Number 7, do not originate any inquiries on your credit card. Sean talked about inquiries having about a 5-point effect. Not the point. You still have to explain to an underwriter what that inquiry was and if a debt was incurred. And if a debt was incurred, we want to know how much and do you still qualify? Don't open the Pandora's box. It's not necessary and another self-inflicted wound. Number 8, do not make large deposits without first checking with your loan officer. Just give us all the bank statements as requested. Last 2 months bank statements for all accounts. We'll assess where everything is. We could check each account. You don't need to move money around and so forth, which brings us to number 9. Do not change bank accounts or move money between accounts. We don't need to do that because you have to, again, explain anything with a large deposit, any transfer of funds, and it gets to be tedious. And, you don't need to be doing that at this juncture. You just want to get into your house. This, again, is self-inflicted. And lastly, do not co-sign for a loan for anyone. If you want to do that after you have your house, you're welcome to. But understand, if you co-sign for someone, whether it's a house, whether it's a car, whether it's furniture, whatever, that whole payment, not just their payment, that payment might be counted against you. If it's a house, definitely. If it's a car, they would have to have been making payments and show they've been making payments for at least 6 months without you on their checking account. So they would have to show that it was totally on you. I think there's some questions in there that we probably get to. And so let's get right to it. Why doesn't rental payment history affect credit? Well, Sean, do you want me to tackle that?
Sure.
Well, rental history, there's some things taken for granted in the mortgage lending industry that paying your rent on time is expected. So there's never, we can't just say, hey, he paid his rent on time or she paid her rent on time. That is taken for granted that you're supposed to do that. So when there was supposed to be, we thought last year when they started using credit, right, Sean, in the credit report, that it would help, but it doesn't. Not yet anyway. It hasn't come to that we are taking credit. But I guess if you're making a case, if I'm the loan officer and I'm making a case and you're tight on everything else, I'm going, hey, we have a borrower here with 36-month rental history, no lates. They've been at the same employment for X amount of years. That just puts you into the psyche of an underwriter on what something tight might be needed. So it's critical that you pay your rent on time. Unfortunately, it's not going to be on the credit report to have a positive effect on the score, but it will have an effect on underwriting. Are there national home advocacy programs I could take advantage of? There are programs that you will have to look into. That stems from not necessarily lender to lender. You would have to look at the advocacy program. I would say that programs in the different city, like the grant programs we went over 2 weeks ago in Maryland, in Virginia, in DC, those might be more likely than receiving something on a national basis. I don't know too many national programs, and if there is, it could probably be because of the bureaucracy of it, time consuming, and whether or not it will lend you the kind of money that a grant program would lend you locally, because every jurisdiction have different rules and different guidelines. Are there special programs for entrepreneurs? I would say we're A-paper lenders. We're an A-paper lender, means that we're going to lend you at great interest rates, and we're under Fannie Mae and Freddie Mac. It is, we're not going to have anything that is going to be specific to self-employed buyers. But we know how to get self-employed buyers approved if they have their tax returns and so forth. What self-employed buyers have to be careful of is their year-to-date profit and loss and writing off too much of their income in the last 2 years. That is absolutely critical, that they understand that we're going to go exclusively with their tax returns on generating what kind of income. Regardless if you're making the money and you have the receipts, that's great. But if you write it all off so you could better your situation with Uncle Sam at the end of the year and recoup some of that, that's where it kind of comes back to get you. But we know how to get it done. I would also state that entities that are looking to give you any kind of programs on self-employed are not going to have the kind of interest rates that an A-paper lender might have. How long is the closing process once we have an interested buyer? Ferguson, I will say this, for my team, as soon as you have a ratified contract, you're going to close within 3 weeks. Less than 30 days, definitely, but I would say 90% of the time, if everything is in good order, 3 weeks, and we've closed in as short as we've closed in as soon as 9 days. So it's not a problem in doing that. Ferguson with another question, and that was a great question, by the way. How do we become eligible for a larger home loan once we have been pre-approved? That's no problem at all. If you are pre-approved, and you should know how much you're approved for. So let's say you came in and got pre-approved and the maximum you're approved for was 500,000. Okay. And you want to go to 550. Well, we'll just have to look at the numbers and see, is there any move that we could get you to 550? Is there any way we could push the envelope on your debt to income or your housing ratios? That's where we would look at it and see where you would be approved. Is TowneBank Mortgage a national lender? TowneBank Mortgage is up and down the East Coast, and we do lend in Alabama, Tennessee, Louisiana, and Ohio. I have to look up Mississippi, Mr. Ford, and see if we do. So you're welcome to call me. I will, before I sign off, I will give everyone my phone number and my email address. And I will share my information, as I was someone else just asked me to do that. And I'm going to do that right now. My phone number is 571-278-8351. My email address is Shirvan, SHIRVAN .JOSEPH at FitzGeraldFinancial.net. And if you look on your screen, my contact information is right there. And again, if you have, you contact the informer. If you can't find it, you're welcome to contact them, and they will certainly give it to you. But we've had some great questions, and I really appreciate that you guys tuned in. It's a great series, and we'll be more than happy to contact you. I think there's a button you could also push on the landing page of the informer to fill out an application or to contact me as well. So that's available as well. And if you have any other questions, please feel free to ask before we sign off. I think that's it. Great questions too, by the way, and we appreciate again everyone attending this 4-part series. Look for us in the near future to do one, potentially in Black History Month. And please reach out to me. Again, it's 571-278-8351. And turn it over to Sean if he has any closing remarks.
No, I was just really impressed with the questions tonight. They're really, really engaged viewers, and you did an awesome job as usual, Shervin.
I thank you. I appreciate it. We complement each other well. We're an old married couple with 15 years together. That's what people would say, because that's how we kind of gel together, and we both know the business, and we both care about people and getting people into homes, and we care about what we do. So
that's right.
The old adage of we love our jobs, I think, hopefully shines through on what we do. So without further ado, I want to bid everyone a good evening. I thank you again for tuning in, and I look forward to speaking to any of you to give me a call and hopefully resolving some issues. You guys have a great evening. Take care and be blessed.
Good night.
Good night.